Hello, hello. Welcome back, everyone. We are back for another edition of the Higher Standard Live, and I promise you it's going to get better. Woo! I don't even know where to start today. This has been a pretty eventful day in the markets. You got the president meeting with oil executives already in Miami. You're going to have Pulte, and you're going to have a lot of the housing stuff. People talk about some of the things that may be coming in Davos for housing, which is kind of wild. You got some housing numbers which came out, which had a bit of an error or possibly a data leak, lots of issues there. And you got a lot of really weird stuff. Meanwhile, crude oil's on the rise. Housing rates have dropped down. All the housing pundits are going bonkers right now. This is going to be an interesting day, and we haven't even really seen the meaningful data which comes out later on in the month. And of course, there is some GDP speculation that we're going to get into. Yo, let's go to the chats real quick. What's up, Isabella? What's up, Rosie? What's up, B? Everybody, I appreciate you dropping in. I got to tell you, I'm excited because this is also an interesting show where we're going to be rolling out some new tech. So if anybody who's watching wants to get a little bit of a sample of what some of the new tech looks like, drop a name of a stock that you watch, and I'll drop it in here in the live, and you can see some of the stuff that I've been working on nights and weekends just to try to make all of this whole tech stack really, really cool. Anybody got anything? All right, so somebody said Chevron. Okay. So what I'll do is I'll go up into the markets right here. I'll hit Chevron's ticker symbol, CVX. Hit generate chart on my end of things. You don't see anything yet, but what you will get is you will get this bad boy right there that pops up. I'm purposely covering my face because I want it to be impactful, but effectively, this is what we can do now, which is really cool, right? If I wanted to go to the 1 year mark, I hit 1 year, spread of the chart, and you get the 1 year blast. If I want to go to a different stock symbol, let's just say somebody else said Pinterest, which is a strange way to look at it. I hit enter, and then you're going to see it generate on your side of things just like that. So I like to think of that as a pretty cool feature, but definitely going to allow us to get into some of the responsiveness in the markets in a lot better fashion and have our own branding. I hated going out to the market and seeing everybody else's take on doing it. And it's just as simple as me clicking on and off right there. So let's get back to the main show. And I appreciate you guys being patient while I nerded out a little bit, because I got to tell you, that stuff was really exciting for me to put together and finally get released out. What up, chat? Saeed is here. VXS. Sorry, Rosie, I caught you a little late. That being said, let's jump right into some of the headline stuff that we're seeing over here. Let's take a look. Okay, so U.S. December jobs reports, employment, unemployment, payrolls. That was published this morning, and markets are reacting to it. It's been kind of weird. BLS and Department of Labor rules. President has the ultimate authority on releases. I want you guys to know that. So technically, the Bureau of Labor Statistics and the Department of Labor are all under the president's authority. He can shape the rules around that. So there isn't anything wrong with what I'm going to show you here from a social perspective, but there certainly is, or at least seems to be, some disconnects into what we're seeing happen here. So I'm gonna jump right into some news that we're going to cover here. Let me jump over to the bigger screen, and we'll talk about this from CNBC. I'm going to go into this view here. Perfect. All right. So 2025 was the worst year for hiring since 2020. December jobs report shows the U.S. added 50,000 jobs last month, a mixed report capping off a difficult year for the labor market. And that is a pretty crazy headline when you think about it in and of itself, that we've seen such a significant pivot in the job market starting to be material. Unemployment is rising. Meanwhile, GDP seems to be holding strong, and that is largely propped up by consumer spending. 70% of consumer spending, and we now know from stuff that we've seen throughout the year of 2025 that 70% of consumer spending is really coming from the top, call it 20% of Americans. So there certainly is a financial change happening here. This all while the president has said openly that he wants to ensure that home values stay there, because a lot of his primary constituents own real estate, and he wants Americans' home values to stay high, which I don't necessarily know if home values staying up is a good thing with what we know is an overinflated market, and all the data says that. That's not my speculation. You certainly don't have wage growth, which has kept up with home affordability. So if we're going to keep home values high to keep this population of Americans who have homes in check, and the stock market's super high, and that's going to keep things going there, the cost to invest in the market is going to get more and more challenging. Equity appreciation over time is going to continue to come down. So I don't know how that solves that rubric, but here we have jobs. Jobs is a problem. Let's read a little bit from the report here. The U.S. economy added just 50,000 jobs in December, capping off the worst year for hiring since 2020, when the COVID pandemic brought the global economy to a standstill. That was a different time, but worse results now. That's got to be AI, right, kids? So, say for 2020, the last year ranks as the poorest year for job creation since 2009 and the global financial crisis. I would say Jerome Powell and the FOMC said they haven't seen the effects of AI, or not looking at the same reports that you and I are, because if you look at this report here, it seems to be pretty important and it seems to be pretty significant. So, just 584,000 jobs were created in 2025. Far below the more than 2 million added in each of the prior 2 years, and the more than 4 million hires in 2022, the height of the post-pandemic recovery. Last year, the labor market added jobs at an average rate of 48,000 jobs per month after revisions. In this chart, new jobs added each month. That's a pretty good chart. If you're on the vertical platform, it's going to be a bit harder for you to read, but I'm really talking about that bad boy right there. And if you look at it, these two periods of time, that's not very good. You're showing a pretty continual drop off. But let's do some observational viewing here. You don't have to be quantitative. You don't have to be a quant. You don't have to be an expert in the data. Just look at this. Okay, you saw a peak and then a drop off that's gone pretty low. And if you were to look at this in a different format, probably a line chart, you'd see it come down even more. If this is heading into this direction, it's because something meaningful has changed in the economy. You could call it seasonal, but generally speaking, seasonal goes up here. So I don't think job creation the job economy is as strong as we think that it is based on outdated numbers. This is kind of why we've called for there to be a different look at how we value these things. I don't think it was a complete surprise to anybody, and certainly the article goes on to talk about this, but I do want to get into a little bit more from this article because it sets us up for some data leak stuff that we're going to see in a couple minutes here. And then we're going to go to the social medias. Saeed, if you're watching this on Instagram, do me a favor, go over to YouTube. I want to make sure that the YouTube restream feed is working. I'm not sure that it is on my end of things because I haven't seen any comments from YouTube come in. And if you are commenting, then I apologize. I'm not seeing you. I might not need to re-auth on my side, and I will check that real quick. That being said, this is a meaningful report. Government employment plummeted in 2025, especially in October, when tens of thousands of federal employees whose jobs had been eliminated under billionaire Elon Musk's Department of Government Efficiency, remember that, came into effect. And, well, that came and went. But the fact of the matter is AI is still impacting jobs, government employment, and those jobs were certainly part of the biggest shift that we saw. But I think you're seeing a slow drip over time of efficiency, all while corporate earnings are staying up and dividends are staying low as capital expenditures into the market are increasing. So you're going to get higher valuations in companies because they're making more money. You're going to get more unemployment because companies are getting more efficient, getting less distribution of those proceeds to the individuals. So it's interesting to me to see how this is all working. Economists have said that the rising immigration in recent years helped to address persistent U.S. labor shortages and bolster the jobs market as a whole. There's dual sides of that spectrum. I don't want to get into the political semantics there, but for months ahead of this report, the overall labor market has been shrouded in fog and conflicting signals. And we have believed on this show that those conflicting signals are largely the part of the result of outdated data sources and looking at things that aren't necessarily important. So let's jump over this. Actually, let's take one more fact from this here, that this one bottom paragraph I think is important. The unemployment rate, which has trended higher for months, fell to 4.4% in December. The decline was due in part to adjustments applied by the Bureau of Labor Statistics, so the decline is less than it appears on its face. I don't care about the decline. I care about 4.2, 4.3, 4.4%. That is the trend. We're going to jump into another report, which I think is worthwhile to share and review. So let me go ahead and pull that over here from the Financial Times. This is actually fascinating. There seems to be some data leakage here. And for those of you who are not familiar with the reports that come out from like a jobs report, for example, one of the things that I think a lot of people miss is that these things come under a whole heavy amount of security. You have to have a special word that you say in order to get the reports. The president gets access to this information the night before, and he is technically the head of these agencies that report this data. So they know the night before this comes out which is why you woke up this morning to a bit of a slanted rhetoric on social platforms from the executive branch, which talked about how the employment numbers were not necessarily significant. But this was the real reason why that nobody's really addressing. Over on Main FT, a gentleman here has been writing about the jobs recession among PhD economists. Government isn't hiring, universities aren't hiring, but not to worry. There will always be a demand among Wall Street firms seeking to get an edge on where the latest employment numbers will land, right? Well, not necessarily. Not if President Trump has anything to do with it. An apparent breach of the embargo on federal data releases and a full day ahead of the actual release, Trump issued this. Now, this is an interesting move here. This right here is a chart that he's talking about, which since January, the private sector accounts for all new jobs created. Federal government jobs are down 277,000. And then he gave private sector jobs versus fewer government jobs. And this was the information that was released by the Bureau of Labor Statistics and other bureaus to him the night before, which is released to us, the general public, the day of. And to get that data, you have to go through a whole shrouded process of secrecy, which is not necessarily, I don't know. So it used to be really important, and now they still use the same word. You go into this room, you give them a word, you can get in, you can get the data, you can get out. But as a person who heads this division, it's unclear whether he is going to be punished or should be punished for breaking his own rules of his own divisions. I think it's not a non-event, but basically the president leaked the data report that came out today ahead of schedule by doing it and spinning it in this way, which is an interesting narrative. The numbers match Financial Times' sum of the monthly official job numbers for February through December, so it seems pretty clear cut that if you look at this, did Trump's truth move the markets? It doesn't look like the Treasury market paid much attention. So I guess if you look at it in the context of, okay, so the president released data early, effectively a day early, trying to get around the media of what is perceived to be a bad jobs report, particularly during the holiday season where you normally have more hiring, right? Well, according to this, 10-year Treasury did not significantly move. 10-year Treasury obviously being the biggest impact on mortgage rates. You have seen mortgage rates drop today. But that is not because of this. That is because of the housing stuff that we're going to talk about coming up shortly, where you've had Pulte and some other people talking about some of the things that the president is likely to disclose and talk about when he goes to Davos coming up, because he's talking about changing the way institutions buy property. Now, if you listen to previous lives or our podcast, which drops on next Tuesday, we cover how this is actually bad data and not necessarily true. If you look at institutional investors as people who own 1,000 units or more, less than 3%. If you look at people who own 100 units or more, it's about 5 to 7%, depending on how you calculate the ownership there. So this is not a meaningful move to the markets. You've seen some of the housing companies and builders take it in the shorts on this stuff, but I don't necessarily know that that's been the right answer, the right perspective. There has been a popular rhetoric, and I'm going to switch over here to the teleprompter for a second so we can talk about this intimately. But there has been a rhetoric on social media in the not too distant past that, institutions were the devil and that they were buying up all the homes, and buying all the homes meant that less for you and me and the consumer, and that was driving up home prices. Well, yeah, I guess if you look at 100 properties or more, that 7%, it could be perceived to be meaningful. But again, that's nationwide, and you're taking the average of the acquisitions in certain regional submarkets. And again, real estate in and of itself is very, very regional. It's hyper regional. So in Orange County, Southern California, where I live, you're going to see very different price and value changes than you are in Oklahoma City, where I think the valuations are a lot less increasing and decreasing over time, and there's a lot less impact over them. But there are going to certainly be regional differences here. So I don't necessarily know that the rhetoric of them moving the needle with 7% acquisition in aggregate is a big deal. But let's say you limit some of the major buyers here. The major buyers are really only buying less than 3%. And that is not enough to move the market. And as a matter of fact, a lot of these home builders have been net sellers in the market. Blackstone being a great example of this. They buy a ton of multifamily mortgages on the secondary market, and they own a lot of mortgages. They certainly own a lot of real estate as well. I'm aware they're selling some properties too. But in that ownership, they've been a net seller over the last decade, not a net buyer. They have actually sold more properties in the market than they have bought. So this rhetoric that you're seeing from a lot of places about this being important, well, it's not necessarily true. So then you have to ask yourself the question, why, right? Why is that a narrative that's coming out? Okay, well, the obvious low-hanging fruit here is you've got midterm elections coming up, and the Republican Party wants to keep their control over the House, the Senate, and obviously the executive branch. And in order to do that, you have to appeal to some of the concerns that are prevalent on places like social media because that is the popular sentiment. So they're going to try to do some of these things. We've heard some rumors of a 50-year mortgage for affordability. Now, I think the internet reacted very badly to that. They thought it was a terrible idea, and for good reason. If you take the impacts of compounding interest over time, a mortgage that would have only cost you about $1 million in interest if it were 500,000 would cost you a whole hell of a lot more, amortizing that for another 20 years, if you will. And Syed, I just got a text message from you, which is unusual mid-show. So I'm going to take a look here and see what we got here. I've been following the German military contractor Rheinmetall. A lot of new revenue contracts were signed the past 2 years. Yeah, interesting sentiment. Let me actually, while I'm doing this, let's take a minute here to pause. And I'm going to take a look at a few things while we're talking. If you're in the chat and you have anything you want to talk about, now is the time. And I apologize if something gets a little wonky here. I'm going to re-off something that I think is a little off on my end of things. Yep, there it is. All right, so this should allow the YouTube chat to come back into my stream on my side. So I apologize. I've been a little unresponsive to you on the YouTube side and some of the other platforms because I'm looking at it a little bit differently on my end of things. Let's see if the control panel kicks in here. If it doesn't, I will shut that part down and come right back into it. I don't think, oh, there we go. Let's allow it. It might not let me to allow authorize midstream. So if you're on YouTube, I apologize. We'll have to get to you guys a little later on that one. That's my fault. I probably should have authorized before stream. So give me 1 second. I will fix it. I will fix it. There we go. All right. Okay. So in order to fix it, we're going to go here. Okay. So let's take a look here. What a smooth, sexy camera transition. Thank you, Isabel. I've been working real hard on all of this stuff, looking super good for all of you because I think it's important. One of the things I think is important to talk about here in the jobs report that we're not going to get really, I guess, visible in most markets is that there's a human element here that I think is being ignored, right? People are generally afraid to lose their jobs. And if you're afraid to lose your job and you're seeing all this stuff and you're saying, okay, well, the market signs here are that the economy's booming and that we're seeing all this lift, like, shouldn't I feel better about things? And the answer is no. Wage inflation is not kept up for most Americans with the cost of living. We've talked about this on a number of shows, but I think it's always important to talk about and to reiterate and to make clear that we are not trying to be insensitive to the idea that a lot of Americans are hurting financially as a result of some of the things that we're seeing here. So I'm going to go over to the social view. One of the things I like to do on this show is to bridge the gap between traditional finance and mainstream media. And in order to do that, we like to go on to the social platforms and talk about some of the things that we're seeing. I'm going to do a little bit different view because I think this presents a little bit better here. So for those of you watching used to the traditional social view, we'll get back to that. But let's go to the screen view here. Let's take a look at some of these numbers. These are pretty crazy numbers when you think about it. So let's start off with this chart here from Yahoo Finance, 49,000. The average monthly U.S. job growth in 2025. That's the slowest annual growth outside of recessions, according to Jed Kolko, senior fellow at the Peterson Institute for International Economics. That's a pretty powerful statement, particularly this line here. That's the slowest annual growth outside of recessions. And if you followed us for any length of time, 2 consecutive quarters of negative GDP growth is, in fact, the technical definition of recession, despite the trying to rechange that or reframe that with the prior administration saying that 2 successive quarters of negative GDI growth, gross domestic income growth, also was required. That is not true. So I think the definitions of a recession probably need to be looked at in light of what we're seeing here, but this will be a slow burn over time. Some of these agencies just take a long time to change. 26% the share of unemployed people who have been without a job for 27 weeks or longer. Wow. That is the highest level since 2022. This is from the Bureau of Labor Statistics. So there's also some problems with this math too. The way they account for this is fundamentally wrong. And you have to be actively looking for a job. You have to have met certain criteria. So I don't necessarily know that a lot of this is true per se unemployment. I think the actual number is much higher. I think a lot of people give up. And those who are employed also have side hustles. You have to have a second business these days in order to really keep up with your income. Because if you've had wage inflation at 3% per year for consecutive years, but then you've had cost of living increases, which we've covered on prior shows, is in excess. Real cost of living is in excess of 25% from 2019 to 2025. You've got to take on side hustles just to keep your standard of living, not to be greedy, just to keep your life going in the same place. So that is a pretty crazy series of numbers when you think about it. And I think what social media is trying to tell us is that they're concerned, and that this is look, the way social media works is pretty obvious for everybody. It's attention media now, right? And I'm part of it. I'm part of that problem ecosystem, if you will, where the headlines that grab Americans' attentions are the headlines that keep people watched, good, bad, or ugly as they may be. It's generally negative, but that's the fact that you have to deal with, right? So the stuff that people feel is what grabs attention, and attention is what gets more and more eyeballs on it. And this is parasitic cycle of bad news. And I get it. Mortgage rates dropped to lowest level in nearly 3 years after Trump's latest push on housing affordability. Mortgage rates fell sharply on Friday, a day after President Donald Trump said to social media that he is instructing mortgage giants Fannie Mae and Freddie Mac to buy $200 billion of mortgage bonds. Keep in mind the Fed has non-QE, QE, non-quantitative easing, where they're trying to put money into the markets because they said that people were going to need money for tax time and payments were going to flood out of the system. So they need to put more cash into the markets. And now, in an opposite response to this, you've also got the president instructing the GSEs, Freddie Fannie, to now buy $200 billion in mortgage bonds. And this drove the 10-year down today. That's what really drove it. It wasn't necessarily the labor markets. And vis-a-vis the 10-year going down, you also saw mortgage rates drop below 6% today in a pretty interesting move. And these are volatile times. You're getting single individual commentary that is really moving the market way more than I think that it should. It's just my personal opinion. This will drive down mortgage rate. This will drive mortgage rates down, monthly payments down, and make cost of owning a home more affordable. He said in Truth Social post. The rate of a 30-year mortgage dropped 22 basis points to 5.99% of the news, matching the low from the February 2nd, 2023, according to Mortgage News Daily. So I'm going to take a bit of a different take on this, and I know it's going to rub some people the wrong way. So I apologize in advance. I'm just trying to provide perspective, okay? So let's look at the bonds here. This is your 10-year. It is down still again today, down to 4.169. And for those of you asking why I do this here, and I don't do this with our own charts, is I like to look at the bond market on CNBC just to give people perspective of where they can go and see it, because I track it. You should track it. Whenever I'm just looking at general companies, we're going to use our charts just to have on-key branding. But so yeah, you're seeing this drop. And I know this looks like a small drop here, but this is actually a meaningful number to the mortgage markets and the 10-year treasury. So look, the National Association of Realtors, the mortgage associations, the Home Builders Association, and this is going to be one of those face-to-face conversations where I want to look you right in the eye sockets when I have this dialogue with you. Their solution to the affordability crisis has always been lower rates, okay? There's a couple different ways you can do this, and I don't think anyone's got a solution, so don't look at me as saying, I know how to fix this problem. I don't, okay? But number one, if you want homes even more affordable, you can lower mortgage rates. Number two, you can lower home prices. Now, it is a convenient narrative for these associations whose business is to either sell homes at the highest possible price for them to earn a commission, or to make loans at the highest possible loan to value loan amount, which is based on value, to earn them the highest possible commission on said proceeds. I'm not saying that's everybody. I'm not saying they're bad actors. I'm just saying it is in the interest of the associations and the lobbying groups to lobby to benefit their constituents, which do happen to have a vested interest in the outcome. Again, I'm not demonizing anybody. I'm a realtor as well. I'm a real estate broker as well. I do that. I've had that for 20 plus years. I'm full support of the industry and the franchise, but there is a benefit you cannot ignore to them arguing that particular use case, right? And if you own a lot of real estate, the last thing you want to do is your home values to come down. And you might very much say, look, like this is fine. It's all good. It's incremental differences, whatever, blah, blah, blah. But this does not materially impact affordability. If anything, this saves affordability a little bit of money now, but drives it up longer term in the duration, because this is not solving the underlying problem. Wage inflation has not kept up with the life cost of living inflation and jobs being a huge part of that, shelter being the largest component to inflation that we've seen in recent years. So let's just go over the three dials that we can turn to solve this problem. And I'm going to, spoiler alert, they're not going to get fixed anytime soon. Number one is cost of homes, right? Cost. You could lower the cost of homes. If they go down, right, then homes get more affordable. That's pretty simple. Number two, you could lower rates, right? And this is what everybody in those lobbying groups typically lobby for. And the president does own a lot of real estate, does have a lot of home builder constituents who want to sell more properties. Perhaps this is how you address them, because they certainly supported him when he got into office. You got to understand there are some allegiances there, and you better rest assured that the president will have conversations with the home builders prior to whatever conversation he's going to have in Davos, okay? And likely already has had them now. The third thing, which is, well, frankly, the one that is least likely to happen, is wages. Okay? That's the third thing that you can change. If you can't bring down the cost of homes and you can't make it cheaper to finance them more meaningfully than it is, and we're never, I mean, even today with everything the president's proposing, you're not going to get back to 2 to 3% rates, even if you get his entire team in the FOMC meeting. They cut rates like crazy, which, by the way, has moved out. The prediction on rate cuts now, the first cut, I think, is June, which used to be as early as January. So there's a whole smorgasbord of things happening now. This is shaking up a lot of things. And if you're the FOMC, you're just getting a lot of extra variables that weren't in the equation when you made your last rate cut happen in December. So, of course, the third thing you can do here is you can increase wages. Wages haven't kept up. If you increase the ability of the general consumer to buy, and I think this is part of the reason, in small part, why you're seeing a lot of UBI, universal basic income conversation happening, is because of this issue right here. I think a lot of people are going like, okay, wait a minute. Well, if we give people a little more money, then we can do this, because companies aren't going to inherently pay more. Why? Because we covered this to start the show, and that's why we started there. If unemployment is increasing and companies are getting more efficient and they have the pressure on them to stay more efficient, then there is an unlikely chance that you're going to see significant wage growth in the next couple of years, because they're going to allocate those resources to AI. The AI adoption process is simple. You adopt data, you adopt a model, you run the data and the model together, and you commit to them for a prolonged period of time. Then you implement those and you see how you can increase efficiency. If all these companies have been on the public exchanges talking about how they are going to improve efficiency for their company for a long time, they have a fiduciary obligation to their shareholders to implement said technology and improve the valuation of their companies. And by approving, there's only two things they can do. They can make more money with it, or they can be more efficient. Be more efficient, if you read between the lines, means less full-time employees. That's where this goes, and that's what the FOMC is afraid about, and saying that we don't see the data yet. I see the data, but maybe I'm just being a little biased, because that is my belief, at least currently, in the current climate, as to what I'm seeing right now. So, that could change, but as it relates to the markets, that's a meaningful number. So let's take a look at a few things real quick before we transition. I think it's important to talk a little bit about the mortgage market. Let's see here. Give me 1 second, and we'll pull some of those up. All right. So I'm going to use our handy dandy tool here. Let's look at DHI, DR Horton. Let's look at a 1-day model here. And I'm going to pull up the chart view, which I got to tell you, I love. There's DR Horton for you. So they're generally up on the day. This is over yesterday. Let's look at them on the 1-year chart here. Let's do a comparison. I think DR Horton isn't going to be too far off at 156.25. So again, they're doing pretty well. If you look at the numbers, seems to be a pretty healthy growth trajectory there. So let's see here. Let's take a look at a couple. Let's look at one more just to get some context here. Let's look at Lennar, I think. Let's take a look at them and see where they're at. Let's look at them on the 1-year chart here and see where they're at. All right. We got Lennar is down modestly year over year, 1 year. And you can see there's some pretty significant changes there. But let's look at intraday, 1-day chart. Take a look at that. Okay, so not the world's greatest performance, but not the world's worst performance. And let's see how some of the people who are buying the stuff in the markets in the back end of things are performing, shall we? KKR, let's look at Blackstone. Let's look at all of them. KKR and Co. Okay, so they're up. Let's look at, yeah. Well, you know what? That's fine. I want to say Blackstone is BKR. It's been a while since I pulled that up here. Let's take a look. Nope, that's Baker Hughes. All right, so I think it's safe to say the market is not super reactive to this particular current thing at this point in time, despite the fact that I think a lot of people were really expecting there to be changes. I think everybody's effectively waiting to see what happens in the next couple days, particularly in Davos, which is next week. So you're going to see a little bit of hesitation in the markets, a little bit of calm. But let's go on to our next topic of the day, which I think is important. GDP Now estimates. The Atlanta Fed GDP Now model has indicative estimate of Q4 2025 GDP growth of about 5.1%. Okay. That is kind of crazy. Now, GDP Now, we've watched a lot on the show. And that's why we're in this particular view now, is we're going to watch that a little bit more. So let's Google that real quick, pull that up. Atlanta Fed GDP. All right. So Said and I often go here whenever we're talking about this on the podcast. This is the GDP Now figure. There we go, right there. Maybe not. Come on, internet. There you go. GDP Now, growth rate of our gross domestic product. They estimated Atlanta GDP Fed Now, GDP estimates for Q4 of 2025. They're estimating this, and it gets closer and closer. It gets more and more accurate. Well, look at the difference there. They're estimating this at 5.1%. That's a pretty big spike. And if you're uninitiated, if you will, they're really talking about this uptick right here. That is a pretty interesting change. So basically, if you're saying gross domestic product is going to be 5.1%, it's not an official Bureau of Economics release, but it certainly is a noteworthy release. I think you have to kind of look at this stuff and say, okay, wait a minute. Who's spending this money and how is this being calculated? Because if you're looking at GDP growth over time and it's growing that meaningfully, where is it coming from? I mean, it's a fair question, is it not? Let's go to the chat. I don't know that I can see a whole lot of this. There we go. Look at all the chat going on over here. Okay, got somebody on X. Got my guy Matt Hayes. What up, everybody? I apologize. My view has been a little impeded because I have some back-end tech that I got to fix here. Let's go. The public, assuming Q1 sees positive development overall markets, I think we move higher. If you take this stance, where would you be invested in H1 26? Have to spend some cash in markets right now? Utilities, emerging markets, QQQ. Okay, so yeah. We've covered this on previous shows, and we think that it's important to kind of differentiate. The old 60-40 split of equities and stocks used to be kind of the mainstream way you would invest your money. But I would say you've gotten disproportionate and uneven returns in recent years as a result of that. We've been big fans of the QQQ, particularly if you believe in technology. The top 100 of the NASDAQ seems to outperform the rest of the market. Okay, we actually suggested that the new 60-40 split for what's going on now with this AI revolution and the backbone being data would be possibly a split between the QQQ and Bitcoin. And I'm not even talking Bitcoin through funds. I'm talking hold Bitcoin in a crypto wallet like MetaMask, like Robinhood, and hold it there directly, because the more you hold of that, the more likely you are to do well. And you've seen Main Street adoption. You've even got Jamie Dimon coming out now saying positive things about cryptocurrency, particularly Bitcoin. The world is nationally accepting more and more digital currency. And if you take a step back and you look at cryptocurrency and you say to yourself, the world is advancing from a technological perspective. That's why the S&P 500 is lifted by 7 to 10 stocks, and the rest of the 490, 493 stocks on the exchange or on that index aren't performing as well as these. You wind up having to take the harsh reality that tech is in fact leading the way. You're looking at the capital expenditures, the improvements into AI and technology and energy, the other question, which I'll get to that part of the question here shortly. And you say to yourself, this is a landscape that is changing and you should invest in it, because home affordability is really hard for people to buy. Okay. You can't buy a home. Home affordability is really difficult. That solution seems to be evolving, but we don't got any answers yet. Maybe we'll get something in Davos. Maybe it's a 50-year amortization. I don't support that, but if that's what people want to do and it helps people buy homes, then so be it. That being said, I think you're going to wind up in a situation where Bitcoin, the QQQ are going to be outperformers. I would put my money there near term, certainly. And then long term, that you'd have to play a little more cautious than you would and be a little more mindful of it. One of the things for most people with their equity appreciation over time, it was unrealized losses and gains. Whereas with the stock market, you can look and see the valuation every single day. Even with Zillow and Redfin, you get these Z estimates and valuations. You don't really know what's in your home, so it doesn't become as indicative of value for you. It's not like your 401k. If you remember during the great financial crisis, people lost their 401k, they lost their mind. And because of that just in their face valuation, it was really impactful. So on energy, we also think the energy sector is a really powerful play. There was some news today with Google talking about energy. Actually, no, it was Meta, I think it was. Let me bring that up. I think that's worthwhile to share. I'm going to pull off the chat here for a little bit. And this kind of supports, number one, that question on where you put your money. The energy sector, I think long term is a gold mine, frankly, because I think that's where it's going to go. And I'm not really talking about crude oil and some of the stuff we're seeing in Venezuela. I'm talking about, let's go to CNBC today. I think I saw it earlier today. Let me see if I can find that. That was a really fascinating article. I didn't get a chance to read in its entirety about AI and about energy. Oh yeah, Meta signs nuclear energy deals. There it is, right there. Let's take a look at this bad boy. This is what we've been telling people was coming for quite a long period of time, and I'm not saying necessarily that's a bad thing. Meta signs nuclear energy deals to power Prometheus AI supercluster. We told people this was coming. We told them that the amount of power required to get AI compute where it needs to be is so great that you're seeing these major energy plants be put up everywhere, and you're seeing all of this that needs to be powered. And this is where I think the long-term money is going to be. With oil as a kind of a corollary, I don't see a whole lot of growth in crude oil near term, especially if Venezuela is to be believed about the number one, the amount of oil that they have, and that you can get the infrastructure in there and out. They're meeting in Miami right now with a bunch of oil executives to start working out the infrastructure, but that's a multi-year change. I think near term with there, you're going to have some benefit to some of the shippers, but it's going to be the refiners that make money in the crude oil space. In this particular space, this is what you're going to see happening more and more. Is you're going to see these large companies that are invested in AI, who you traditionally relate to social media, sign nuclear energy deals, get nuclear power plants. Meta said it has secured agreements with energy companies Vistra, Terra Power, and Oklo, which are working on nuclear power technologies. They're planning to work together to eventually power Meta's Prometheus supercluster computing system that's being built at a data center in New Albany, Ohio. That's how much power they need. That is why, in part, some of our home electricity values prices have gone up. There's all this rhetoric around home values and institutional buyers that doesn't seem to be supported by the data. And then I see something like this, which is clearly supported by the data and the narrative. I mean, it's just out there. And stuff like this is happening in plain sight. And no one's going like, why is my electricity bill going up so much? Well, hello, this is why. Tech giants like Meta are investing heavily in nuclear power and signing deals with energy providers as part of their massive investment into AI. And this was predictable. And I think that's where you're going to put your money. You're going to put your money in the energy sector. Okay. Meta on Friday announced agreements with 3 nuclear power providers, including one backed by OpenAI CEO Sam Altman as part of its efforts to secure necessary resources for its AI ambitions. That's crazy, right? When you think about it, that how incestuous this business has really gotten, and it's pretty crazy. Let's go to the stock chart real quick here. Meta Platforms down on the year to date number, but that's just January. Let's look at them over the course of 1 year. Love the glitch transition here, so sexy. There you go, Meta Platforms, 7% ish up. Oh, I should probably point out, it's worthwhile to note, you're going to see the ticker symbol down below. That's real time change today on the orders. This up top is going to be based on the perspective that you're seeing in the time frame. So 1 year, you see the same current valuation, but it's the change relative to the time frame. So you're going to see a bit of a different perspective on the top and bottom. If you're wondering what the difference is, that's why. I give you an idea here. If I do a look back here on the 1 day chart, you're going to see a 1 day, but we haven't clearly gone through the full trading day. You got the hours of the day at the bottom there, but this is comparing the 1 day change versus previous market close. So just to be clear here, we try to make that as visible as possible. So let's get back to this Meta article. Shares of Vistra and Oklo rocketed higher following the news, climbing 15% and 17% respectively. I don't know their ticker symbols. Does anybody in the chat know that? Because I certainly don't. Let's take a look here. Let's take a look at where Vistra's at today. You would think by now I would have all the talks. VST, I think it is. Let's take a look. Let's see if I can find it. Yep, Vistra is in fact there. All right, let's take a look at the stock chart. Vistra there, market open 167.41, up 7% on the day just on that news alone. So yeah, it is having a meaningful impact. Okay, there you go. Let's go to the comments, shall we? So everybody, now that we've had the chat up there for a little bit of time, let's take a look and see what we got going on. Regil, I see you out there. Matthew Hayes, the German military comments, interesting. I don't know enough about it to really know what's going on. Mackenzie in the Instagram side of things, how you doing? What's up? I'm gonna get back to the point where I can start quoting things in a meaningful way. I broke the restream chat today. It's just what happens. Okay, so I do want to cover some other topics that I think are noteworthy and I think are worthwhile. But let's go to one of my favorite views in this platform, and that's the social view. I like the social view. You have to understand there is some risk in doing this, which is why a lot of people don't do this traditionally in news networks, because you don't know what people are going to say. And the good thing is we are not a traditional network, so we can just check and see what people are going to say. This is the Kobisi letter. Mortgage rates have just dropped to their lowest level in nearly 3 years amid President Trump's latest actions. The average interest rate on a 30-year mortgage in the U.S. is down to 5.99%, the lowest since February 2023. This comes days after President Trump just ordered the U.S. government to buy $200 billion worth of mortgage bonds. This is through Freddie Fannie. It also follows President Trump's announcement, which banned institutional purchases of single-family homes. I don't even know if that's legal, if I'm being honest with you, but I guess we'll find out. And then apparently there's going to be more coming to this in Davos. Let's see here. Wall Street Mavs Alliance chief economist Mohammed Al-Rain admits that President Donald Trump's tariff have impacted U.S. consumers far less than anticipated. I think that's probably accurate. Shall we listen in, kids? I think that's probably the right thing to do here. And yeah, if you're wondering, I did get the audio working, so we can do that again. And let's play a little bit and see what we can do, shall we?
There's the exporter, there's the importer, and there's the consumer. Mm-hmm. And so far, the consumer is carrying the least of the burden. I can tell you what's going on right now in companies is they're going product by product, going through the elasticities, what they think the consumer can absorb in terms of price increase without destroying demand. And they're finding out that they cannot pass through as much of the price increase as they want.
Well, that was a stall on their end of things. Don't think our tech is that bad yet. We got lots of time to grow into technical challenges, but today ain't that day. So Mohammed Al-Rain, former CEO of PIMCO, real brilliant guy. I think he's right. We're not seeing the impacts of tariffs, inflation really impacting us so far, but there is a counter argument to that, which I think it was kind of washed over, right? Is in theory, the way tariffs work is, I mean, certainly you saw big companies like Apple preload their exposure to tariffs by buying a lot more and then kind of seeing where everything, happen as a result of that fallout. But you certainly could see tariffs impact people more and more over time as companies start to increase their costs, because they're not going to eat the extra costs they're incurring with tariffs and shipping. They're going to pass it on to the consumer. So you could see that over time. That's going to further impact things. And of course, everybody who loves to be on the other side of things will say, Chris, GDP now in Atlanta is projecting fourth quarter GDP of 2025 to be 5.1%. It looks like pretty healthy consumer spending to me. You got a lot of people out there who are buying stuff and spending all this money. What's the issue? It should be totally fine. And it's like, okay, yeah, but I think the GDP, which is driven 70% by consumer spending, is taking into account a small percentage of consumers spending an outsized portion relative to everybody else. And I think that's a problem. And I think there's some pretty obvious indicators of that in the market. I think some of them, like, for example, this is a good example of it. Home Depot. Home Depot is going to trade a lot differently, right? This is the 1 day mark, but 1 year. Let's take a look at them. Right? I think you're going to see Home Depot take it. And I think that, and look, I didn't know this. I just happen to guess that year over year they're down, and yet certainly they are. If people are getting more financially constrained, they stop spending that excess money they otherwise would have spent. So food for thought. I don't know that the market is as strong as it appears. I hear what he's saying, that the impacts weren't as visible. I think one of the things that we as a society have embedded in our culture now is an immediacy in responses that is probably unrealistic, okay? Particularly when you're looking at things like government action and data. But we are now an attention media driven, world. It used to be social media. You wanted to take your social relationships and your gossip and your drama and throw it online. And now it's purely attention driven algorithms, and it's not who you know anymore. It's what they're watching, which is getting attention now. And it's certainly a weird dynamic that I think is going to be more and more impactful to our psychology, our humanity. But because of that, I think that people are expecting things like tariffs to show up in the economy immediately. And that isn't the way this works. Okay. So again, intimate view. You get to see the side of my mullet haircut, which by the way is getting even more mullety as we talk. I did cut it shorter in the back because I gotta be honest, the whole extra long ponytail thing. Somebody asked me if I was growing a rat tail, and I was like, nope. All right, time to cut it. But that being said, I think that the expectation to see the changes that we get. I mean, so the White House makes a comment, the media responds, the media flurry gets caught up on social media, attention media, and then that we expect to see a response from, and then it doesn't materialize because these things take time to trickle through the system, right? So I think that Mohammed Al-Rain is right. We haven't seen the implications of tariffs on the consumer yet, but I also don't think that we've given it enough time. Companies are going to look at their quarter ends, right? They're going to have earnings calls. They're going to gauge where they can be more efficient. They're going to look at their costs over time. They're going to aggregate all these numbers, and they're going to say, okay, how can we pass this along to the consumer because it's eating into our profits and our profit margins? Some companies, they don't have as big of a deal, big of a problem with this as other companies. Sure, okay, but over time, you see gradual increases. This is how inflation happens, right? Is you have this weird dynamic, this weird expectation in the markets, public markets in particular, where you expect better and better performance quarter after quarter after quarter. And you, as an executive of a publicly traded company or on a board of a publicly traded company, have a fiduciary responsibility to shareholders to return value. Historically speaking, you would do that by doing things like paying dividends as well, but we're seeing dividends now come down to a relative low. I think the second lowest has been in 20, 30 years. And while earnings are top of market, hence driving the economy. And it's such a weird paradigm that I keep going back to because I think it's more meaningful to talk about. As you got earnings at a near high. You got just yesterday, you saw the market hit the Dow, S&P hit all-time highs. And well, it was 2 days ago, sorry. And you've got this what looks like a bubble. And I've admitted wholeheartedly, this is a bubble. The question I keep asking people is what pops this thing? But all these things are lifting off and you're seeing all this change and you go, okay, well, then where is the impact and the benefit to the consumer? And the consumer isn't going to get a benefit unless we can find a way to get wages up. And that's the part that nobody's talking about. You've got to get people earning more money. This hustle culture, this we all need to have a second job. And I do it. Look what I do, right? So you got a 9 to 5 and then a 5 to 9 to make the money that you need in order to keep the same standard of living because life around you's gotten more expensive. Now, your company is likely telling you, hey, you can't have a second job if it's a conflict. And some companies are more amenable to it and good for them. Everybody handles it differently. But I get it. The American consumer, the average consumer is hurting. And the people driving GDP right now is not the American consumer. The people driving GDP right now are the statistical outliers, that uber wealthy, that top 10%. There's an interview from Scott from Bissett, which is interesting, that came out today, which I'm going to skip because I don't want to get into the political stuff. But I think that there's some comments around GDP growth in people are calling this jaw dropping. And I think that's probably accurate. I mean, the GDP growth number coming out was a bit shocking to me. I think it was shocking to a lot of people in the markets. But let's listen to Fox, where you get a little more hyperbole than most from them in some instances. But let's jump into this real quick and take a look at this.
Report from the Fed Atlanta Bank that says we grew at 5.3% in the fourth quarter. This is an absolutely booming economy right now. My God, we just got a report from the Fed Atlanta.
Yeah, booming, right? I'm going to play it again because it was just so cool. Booming economy right now.
Bank that says we grew at 5.3% in the fourth quarter. This is an absolutely booming economy right now.
Yeah. Yeah, I wouldn't call it that. I mean, I think by all outward measures, yeah, it looks like that, and that's hence the reason why I say there is in fact a bubble. But is it really a booming economy, or are we having impacts led by this K-shaped economy that's kind of forming? And I think that's really where it's at. And then you start to look at other charts, and you think to yourself, like, wait a minute, how How could that be? Look at this one. 2025 was the worst year for job growth outside of recession, like we talked about earlier in the show. Well, here you go. Look at that chart, okay? Look at that. 2000 all the way to 2025, the least amount of jobs added in quite a long time. And again, the Fed has a dual mandate. It's jobs and employment, right? I mean, do I got to be the guy? Okay, so let's have this conversation with a little bit of a visual edge here because I think it's helpful, okay? Right here, you got the pandemic, okay? So we can exclude this as a booming year. And I think this year, as a response to what we saw in the pandemic, you saw people hire back what they let go of. And then you saw this downward trajectory after people stopped. Because keep in mind, during the pandemic, everybody got a stimmy check. Everybody had more money. There was more money in American savings than ever before. People were spending that money. I think that's what led to a lot of this. But if you look at everything prior to this, these were not booming trends in the job market from 2000 all the way to 2020. You just saw some pretty interesting offsets which changed that. And now you've got jobs trending in a direction. Now let's carve out this and let's look at it from a slightly shifted perspective, okay? Let's look at this entire chart, ignoring everything on that side of the line, okay? Let's just ignore that for right now as not really relevant. Let's look at the chart work and what it's telling us, okay? From 2000 to call it mid-recession of the great financial crisis, you saw some jobs reductions, but then it went down and it continued to go down. This chart goes down. Most people miss that, right? It's not just down to the x-axis, it's down to where jobs were. So the numbers continue to decrease down. Now jobs went back up and flatlined. The only outliers are this section over here on the right that you're ignoring. Otherwise, this is trending down pretty significantly. And let me illustrate it a little differently. If you ignore the spike from the stimulus checks and you look just at job growth, that's the trend you're seeing. And that is a trend that I think is noteworthy. And I think that is a trend that, going alongside the macro factors of AI, the macro factors of efficiency, and this K-shaped economy that we're creating, I think that is where the problem really comes down to, because you've also seen disproportionate wage growth during this time, and now you're seeing unemployment continue to drive in a direction. So I think the way we look at employment is wrong. I think the way the Fed looks at employment is too much of a lagging indicator. Some of that's government agencies, some of that's just reporting sources. Certainly the way we look at the housing market is wrong. So I take it with a grain of salt. I don't think this is necessarily the right path that we're on, but I just want to point out the details here. I also think that some of this housing dynamics have changed. Rhetoric here is interesting. Let's jump onto this. This is from Kobisi letter, mortgage rate breakdown by percentage versus existing mortgage holders, 2013 to 2025. You're going to see a lot of data like this in the housing markets. There are pundits on one side of the doom scroll aisle. There are pundits on the other side of the doom aisle. I don't know. I keep coming back to the same conclusion that I think is important: is how do you fix these things? How do you fix jobs? How do you fix housing? And to date, no one has given me a really incredibly good answer for that. People will voraciously defend their data and say that it's not as bad or it's not as good as you think, but no one explicitly tells you their solutions. I think the internet was really widely critical of what we saw when the 50-year mortgage was presented. And I think that's because the numbers were very clear. You're paying a whole hell of a lot more in mortgage interest than you are if at a 30-year mortgage. And even the 30-year mortgage at one point in time was a big change for most Americans that we've now adopted and gotten used to. So I think that the idea that mortgage that's another good chart I want to share with you guys real quick. Let's go to the social check here. Let's go to the socials. This is from Chart of the Day, monthly job creation in the U.S. You can kind of see monthly job creation paints a different picture. I think it's a worthwhile note here. Again, monthly job creation also down. So I keep hitting the jobs thing. And the reason why I keep hitting up the jobs thing is because you hear all the people that are in the news telling you that there are no visible impacts to the jobs, even though you've seen this 4.3, 4.4, 4.2, 4.3, 4.4, this escalation in unemployment. But you're seeing stuff like this happen over and over again, and everybody's just turning a blind eye. This is monthly jobs, man. Jobs creation January 2022 through December 2025. That's a pretty big change for the year. in the comments here, end up paying more in the long run with that interest. You're saying, yes, the 50-year mortgage you'll wind up paying a whole hell of a lot more than a 30-year. Let me see if I can find a good chart for that, actually. And thank you for bringing that up. I think a lot of people hear me say that a lot, but I don't actually clarify it. So thank you for that. Let's see here. I saw a great chart a while ago. 50-year mortgage versus 30-year mortgage. I think this is, if I can find it, is a really good chart. Yeah, I think this is a pretty good breakdown. So let's take a look here at this chart. Let me get it up. Gate City Bank, never heard of them, but there you go. Let's switch to the screen view. There it is, kids, right there on the right. Total interest cost per length. So comparing a 30, 40, and 50-year mortgage, for example, the monthly principal and interest payment on a $400,000 home, excluding down payment, property taxes, and insurance at 6% interest would be, okay? So the payment for a 50-year mortgage, for the exact same mortgages across all these examples, $2,105 and some change. 40-year mortgage, $2,200.85. 30-year mortgage, $2,398. So you're only saving, in this case, about that's $95. So $295 savings per month with a 50-year mortgage versus a 30-year mortgage. Affordability, right? Okay, let's see about that. But this over here is the bigger problem, right? So for that saving per month on the average $400,000 home, which is slightly below the average home price in America today, granted, grain of salt, a 30-year mortgage, you would pay for a $400,000 loan, you would pay a little over $400,000 in mortgage interest. For a 40-year mortgage, you pay $656,000 in mortgage interest. For a 50-year mortgage, you're paying $863,371.51 in interest over the life of that loan. So to save $295 a month in monthly interest and affordability for buying a home with a 50-year mortgage, you are going to pay an increase of literally $400,000 in interest over the life of your loan, and more than 2x the cost of the original mortgage amount. So you got a mortgage $400,000, you wind up paying interest of $863,000. So total cost you paid for that $400,000 loan, including the $400,000 back, is $1.263 million. So that is not an economically viable investment long-term for most Americans. And what we're doing now is we're fooling ourselves, right? It's the shiny penny example. Oh, look at me looking so pretty with drawings on my face. Is if you take most Americans and you say you can save this incremental dollar amount, they go, great, I'm saving money near term. But longer term, the banks are making more money off you. And I'm a former banker. I want banks to make money. I'm not demonizing the banks, but this is insane. If you think a 50-year mortgage is going to help you, it's not. It's not. It's going to cost you way more money over the long run. It doesn't solve the affordability problem. And for the average American, let's just say it's $500 a month on a $500,000 home, which is close to the average American home price today. I don't know that that's a meaningful change. Okay? I don't know that it is. So I think that we're lying to ourselves with what we're telling people is going to be the benefit to something like this. And I hope in Davos, this is not the surprise that we get. I think that would be a very disappointing surprise that we get if we get anything. And there's a whole smorgasbord of reasons why that's not good. Now, let's talk about what happens if this does happen, okay? Because I think that's important. If you do get a 50-year mortgage, right? And you do get lower mortgage rates in the near term, and you get these things and you say to yourself, okay, where does this do to the housing market? Well, it's going to drive home values up. And again, if home values go up more than your wage inflation, which it's going to happen, okay, your cost of living continues to rise. How is the American consumer going to afford these things? People say, well, it's a supply-demand issue. And no. I've said this on the show many times, and I'm going to say this again. I'm going to do it in a serious prompter view because it's just sexier. Okay? Demand without affordability is not, in fact, truly demand. It's window shopping. People hate this argument. The supply-demand pundits hate it. If you all want a Lamborghini or Ferrari, right? but you can't afford a Lamborghini or Ferrari. We're not all going to buy a Lamborghini or Ferrari. And for most Americans today, buying a home is like buying a Lamborghini or Ferrari. It's aspirational. You want to have one, but you can't afford it. You'll look at them, you'll window shop, but you can't afford them. And trust me, there's plenty of a supply. If you're somebody who's got means and affluence, you can buy whatever you want as far as a car goes. And yeah, it does determine a little bit of the price and the valuation, but imagine what the price of those would go to if everybody could afford them, right? That's where the supply and demand argument comes in. We keep looking at this like, well, there's this element, there's that element. No, if people cannot afford to buy, all right, there should be more supply. And if there isn't enough supply and people can't buy, that dynamic will change over time. It's a chicken egg argument, I realize, but if you think about it with some context, I think it's meaningful. I think it really tells you what's going on. All right, so I do apologize again for the YouTube challenges today. I promise I'll fix that. I've been continuing to try to improve the show and get things better. Let's wrap up with a little bit of a walk down X. I like to go down to X, but every once in a while you'll see some pretty wild stuff there. So I try to keep you guys off camera whenever I scroll or I go to pages that I know I can trust because it's pretty bad. Oh, I did have one video I wanted to share before we called it a wrap today that I actually downloaded. That's how much I thought it was important. Let's see if I can get it up here to share with you guys. Actually, that, and I've got another video. So this is from the initial jobless claims. So you saw the report today, which everybody reacted to. But then I want to point out this initial jobs, and this was from yesterday. So this is how much the media can swing, and you got to be very careful. You guys ready? Here we go. Let's not get blast you in the ears too much. Here you go.
Shall we? The secret salve of the U.S. economy, what Greenspan called the special sauce. Well, this is the third quarter preliminary. There will be changes. 4.9%, extremely close to estimates, and a really solid number.
Look how excited
in the rearview mirror. 3.3 becomes 4.1 for the last quarter's final. So 4.9, wow, you have to go a long way back to find a higher number. We have to go all the way back to the third quarter of 2020. Productivity's great.
Look at that.
If we look at unit labor costs come in, well, 1.9, down 1.9. That's a minus sign. They are lower.
He's
Unit
legitimately
labor
excited.
Costs are lower. That's always good news. And in the rearview mirror, the 1% to the upside becomes minus 2.9 to the downside as costs drop. And finally, on the trade balance, which we know is going to be a deficit, we're expecting a number around 50.
Yeah, I'm going to cut him off there because his excitement is palpable and kind of disgusting. And look, I get where he's coming from, right? Initial jobless claims appeared down. So it looks like less people are jobless. But then you look at the hiring and the numbers that came out today and you say to yourself, that was a day ago. How you were so excited about that a day ago. But you look at the jobs now and you go, okay, no. And this is where I get so frustrated. You know, all these people are talking about jobs in the market like it's a super healthy thing. Like, and look at his excitement. Okay? I mean, people should be worried. People legitimately should be worried. Uh-oh. President Trump is on with the White House. Meets with oil executives at the White House. I would bring that on live. Let's go all watch it together. Thanks for tuning in, everybody, to the live stream. I'm going to cut this one off a little early just so we can all go watch this press conference and I can play with some more technology. I promise I'll have the chat fixed. Thanks for tuning in, everybody. I will catch you all next time. Okay, bye, as Saeed would say if you were here.